Kenan, great to see you again. How are you doing, buddy?
Gilad, I'm doing great. About to hit the remnants of the tropical storm coming through here. They have flash flood warnings, but luckily I'm inside and hopefully I'll stay dry.
That's great. Be safe. And it's, East Coast. You guys, while we are having fires on the West Coast, you get hurricanes. So much fun. I'm not sure if I will, each one to his own problems.
Exactly. So, although, Gilad, maybe in a future episode, we can discuss the financial impact of some of these weather events on the West Coast insurers and let's say on East Coast ones, particularly, let's say in Florida. Be an interesting we can peel back a little bit of that onion skin maybe and get it to sort of that level of impact on results.
That will be very interesting, especially who is using that, because especially in California, so many insurance left the space because of the risk. And at the same time, there were a few that realized that that's a great opportunity on the specialty and other things. And saying specialty, that will be the topic of today's podcast. And we are going to talk about Ryan.
Sounds like a great plan. Ryan Specialty Group.
Exactly. Now, before we talk about, starting and doing our dive in, the disclaimer, we are not financial advisor. We're going to talk about shares and other things, but this is entertainment and knowledge, not an investment or any type of advice. Great. Now, while this is out of the way, let's do a quick recap about Root.
Last podcast, we sort of did a deep dive in Root, and the market really hasn't been favorable to it since we last spoke, right? They're trading below $10. Metro Mile, I think, is doing even worse at $8. And you got to start to wonder, like, while Root is sitting on a lot of cash, but, at some point, if the stock price of these public companies doesn't change, what does that really bode for the future of this sort of venture capital investment? Because while you might be able to exit, there is a lockdown period. And if in fact your investment sort of starts to dwindle in value, I'm wondering how long these investors will continue to pour hundreds of millions of dollars into the insurtech space.
Well, I don't want to discourage them. I would say, just sit. You don't have any control about it. And wait for it. We still not, having said that, we still see more and more money and capital coming into the insurtech space, and I hope it will continue because we need that money to foster innovation and pump the blood of creativity. But there is still great opportunity here. So let's not discourage them.
Absolutely agree. Speaking of innovation, I saw something very interesting this week, where Holmes Murphy, we're about to talk about brokers. So, they're a very large brokerage group. They're one of the original founders of Broker Tech Ventures. They just reassigned their CFO to be their very first chief innovation officer. So it's kind of interesting. Here's a brokerage firm, more on the retail space, that's creating a senior role for innovation. Makes you wonder about some of these other larger brokers or public brokers. Have they assigned a senior executive to head innovation for them, whether it's an Aon Willis or Marsh McLennan, et cetera? Is there a senior exec on the central committee that's sort of responsible solely to innovate their organization?
Yeah. And listen, at the end of the day, when we look at the dictionary definition of what is innovation, it will be what is the change that will move your economic unit one step forward, right? You can be creative, but to truly have that innovative thing, you need the economic reason. Otherwise, it's cute or it's novel, but you need that extra incentive so people will benefit from it. Having said that, just one or two different items about Root. Congratulations to Washington State. Root started to be really good on the world, or so let's say deliver on the world, which now in Washington State, they removed the credit score. So part of their underwriting now will be without credit score, which is, had his social benefits and of course, distinguish between, removing your social economic status with your driving skills and the risk that you actually have. Also, an interesting thing that you brought to my attention was, of course, they 3 weeks ago they got into catastrophe. So it will be interesting to see how that program will help them, and if people even understand how it's going to grow their business in the future. And of course, it's insurance, so everything is in the long term. Part of them we can see in a year from now, and a few of them we'll see only in 5 years.
Right. On that, innovation theme, even Root, which is an insurtech itself is innovating. They announced that they're using the Tremor platform to try to place their reinsurance risk. Right. And it'd be interesting to see how that improves their reinsurance program.
So let's now jump and talk about our main topic, and that's Ryan Specialty Group, RSG.
So you have to be amazed. Here, a company that was started probably 10 years ago by Pat Ryan when he was in his 70s. He's now 84, has announced that they're going to go public. And it's truly amazing. I mean, the only other insurance executive that I can think of that has been reinventing himself in his insurance companies is probably Hank Greenberg, who's well into his 90s and still running an insurance carrier already still.
Somehow I wish that will be, I'll have the drive and the ability to do it in my 80s and 90s. Seriously. It's one, people who keep on moving, keep on changing. Hey, listen, Buffett, how much did he celebrate? 91, something like that? 90?
Absolutely.
So,
well, don't forget, with all of that nice Lavazza coffee you're drinking, you'll have the energy at least into 100.
Well, I hope so, right? Yeah. Well, that was a brain shout out. But let's go back to insurance.
Right. You got it. So, it's interesting, when you think about Ryan Specialty Group, right? They operate in the wholesale broker space primarily. Mm-hmm. Their bigger competitors are Amwins, CRC Insurance, which is actually part of a publicly traded company, Truist Financial, which owns SunTrust and BB&T and a whole bunch of other banking entities. And then you have other companies in that area, Worldwide Facilities, GenCap, Brown and Riding. And Ryan itself is a merger this past year of them and All Risk. And you actually are seeing a lot of merger activity, not only with these companies buying smaller brokerages, but themselves buying each other or merging with each other. Amwins merged with Worldwide in April. Ryan this past year, right? So we're talking, creating entities that are writing probably close to $15 to $20 billion in premium across their whole organization. And that consolidation, ultimately can provide them with some additional efficiencies, which will hopefully allow them to be more profitable and better yet, better serve their clients. And one of the things that we saw in the S1 for Ryan was around the All Risks. What really appealed to them was the API technology that All Risk had. And it was interesting to me as you're reading the S1, it kind of sounds a little bit like an insurtech play because they talk about this platform that they have called the Connector, right? Which is a digital marketplace where the brokers can place all of this excess and special and surplus insurance digitally connected directly to the underwriter and ultimately place it within minutes. It sounds always better in a marketing document than in reality, but there is definitely something there. And as they are able to digitize more and more of their back office and front office functions, they will gain an efficiency over some of these other wholesale brokers that will give them a competitive advantage.
And, if we are breaking that down a little bit, and again, it's a little bit from that partially blank S1 or the current version that with the opportunity to read as they are gearing up towards their IPO. Do we know when is their IPO, or is it still under wrap?
They haven't
undercover?
announced the date to the best of my knowledge. My guess is it'll be within the next month or two. You don't usually float an S1 and then wait, a particularly
Yeah.
long period of time. But it did give us, as you indicate, a much better understanding of their business and their book of business, right?
Hmm.
Where this wholesale brokerage, traditional broking for a client to an insurer or reinsurer, that's about 2/3 of their business, or about 673 million of their revenue. They do act as a binding authority for some of their
Yep.
carrier partners, and that's the smallest part of their business at 13%. But getting back to a little bit of this insurtech conversation, they have an MGA, MGU, so managing general agency, managing general underwriter, business, and that's about 21% of their book. And they're, in the S1, it's 212 million. So if you actually kind of try to reverse engineer that, let's say the MGA business, they're keeping 20%. So that's about $1 billion in premium. Well, there
Hmm.
are a whole bunch of these insurtech startups, some of the larger ones, that probably were approaching, a quarter the size of that. I'm thinking Next, maybe even Hippo, and certainly Root earlier on, um, and Pi Insurance are probably underwriting collectively more than that $1 billion in premium. So, while this is an important part of their business, I think there is enough competition in this MGA MGU space that it'll be interesting to see how that plays out over time.
Yeah, especially when, as we mentioned, there are three parts to their business. It's the wholesale brokerage that they are all very known for, and that's 61% of their business. The binding authority, and I would really love to talk more about that because although it's a very small part, as you mentioned, 17%, in my opinion, it's one of their advantages that they are a binding authority, especially for specialty ENS, which we don't really see day to day. And let's pin that and talk more about the advantage of being non-admitted versus admitted and how they use that to serve their policyholders and, of course, their customers, which are the retail agents. And well, as you mentioned, the MGU, which at this point is 21% of their business. And
Yep.
when we are comparing that to the uh, insurtechs, the more familiar one, and this is, I think, one of the when you brought this topic up, that's the thing that got got my ears perked. Like, oh, we should talk about this old school company because they were established in 2010 with executives who's been in the insurance space for decades, right? And
Yeah.
how can we compare them to the cool, shiny startups that we see that went public?
Yeah. It'll be interesting. I guess at minimum, I would say they're profitable, right? These startups, the insurtech startups that have gone public, most of them are are direct to consumer, right? Which is a very different marketplace. Um, but if you were to look at an agency like Goosehead, which is a traditional agency network, they're profitable, and so that I think in and of itself is a difference. They are, as you said, founded by the former CEO of Aon, right? So a very seasoned industry veteran, and they've been doing things in a very positive way, growing rapidly, growth rates in the 20 and 30%. Uh, but I would say when you compare them to other brokers in their cohort, they aren't necessarily more profitable than some of them. When we look at their net income, the last year, 2020 net income was $70 million, 70 and a half for 6.9%. When we look at CRC Insurance Services, which I think is the larger component of Truist's insurance business, they're at an 18% margin on net income. You have Brown and Brown, that's about 18%, and Gallagher, which is a lot broader of an organization than Ryan, is at 12%. But that's still double net income margin from then what we're seeing here at Ryan Specialty. And while their growth has happened because A, acquisition, but B, the E&S market itself has really grown. At some point that market will harden, and that trajectory will flatten, and it'll be at that point where sort of the rubber meets the road. And from an investor perspective, will there still be enough juice left in that lemon to warrant holding it?
How can we use the word lemon, an analogy of that, without bringing up lemonade? Very easy. We'll just keep on. So, yeah, absolutely correct when they are talking about the different trends and the things that they're riding, of course. So they had like 30% to 20% organic growth over the years, and we see that on their revenue and, of course, profit. Although in Q1 21, they were in a loss, but that's because of the acquisition of All Risk, and we can talk more about that. But the interesting in terms of the trends, it's that, for example, 70% in the E&S market is not admitted markets, and it's growing. According to AM Best, and we're talking about 2019, E&S is 6.4% compared to 4% of the admitted market, and that's the SAGR. And one of the other things that, as I mentioned earlier, there are more, and you talked about it, there are more and more consolidations and acquisition. So again, 2020, there were about 774 broker acquisitions. So that clustering, and we see that also on the retail part, right? Agent retail is coming as those clusters of agents to get better terms with the carriers. That consolidation of power, it completely makes sense, and it's nothing new. Mergers and acquisitions, we saw Farmers acquisition, right?
And that auto business at MetLife was a very profitable business, just as you see with MetLife, and that's a whole other conversation. Maybe one day we'll go review their results. They've very much consolidated around just the group benefits business now. They've divested their international presence and almost all of their life business already.
Yeah. And that's an interesting trend by itself, which takes us a little bit off the main topic. We see more and more carriers that moving away or divesting from their core value proposition and removing line of business that they go like, yeah, we're not good in that. And it's impressive to see that they admit it and say, we are losing too much money on following on that book of business.
Yeah, I think, particularly for public carriers, that's going to become far more the norm, right? That the markets are going to force the carrier to reevaluate all the lines of business. And more importantly, one thing that we don't know with Ryan is how much of the corporation will Ryan and some of the other key execs own after the IPO. That's not been that those percentages are not in the S1. And if in fact they maintain the vast majority of voting shares, et cetera, then for all intents and purposes, you're not going to have an activist investor, which some of these other companies have seen, which have forced some of the changes, in terms of lines of business or reevaluation, et cetera. Listen, I think you and I decided to cover this because it is an insurance play going public. It's still a little bit early, and it'll be great to review their first quarter public results when they come out, which will probably be towards the end of this year. They'll probably go public, I would think, before the fall or sometime by the fall, in which case the fourth quarter will be released, and then we can revisit it. But what it also might mean, if they are successful in the markets, you actually might see some of these other privately held wholesale brokers choose to either go fully public or float some shares to give them the additional capital to potentially acquire some of the smaller competitors, because this consolidation and this belief that there is advantages to scale, right, will continue. I mean, think about what's going on now with the Aon acquisition, right, and how Gallagher will benefit. But because the regulators are requiring divestiture. So, by the same token, if the capital market is cheap capital, you'll see some of these other larger wholesalers access that market on the public capital side rather than the debt servicing side.
Why do you think that Gallagher is going to benefit from their own Towers Willis, Willis Towers Watson?
Because as part of the deal, Aon announced that they would divest certain parts of that business, and Gallagher agreed to buy it, and they were fortunate enough to buy it at a very reasonable price. And it's areas that are accretive to Gallagher, so Gallagher themselves will end up being in a significantly stronger place. If the deal goes south and they're not allowed to merge, it'll be interesting to see if they're still able to acquire those assets for the price that that they have agreed to pay.
I'm taking us back a little bit for that being about the admitted, not admitted. So what is the benefit and how is that, let's call it the boost for Ryan's success?
In the end of the day, the admitted market means you have to rate file with a state, you have to get the program approved, et cetera. And so for complex insurance needs, that's difficult and challenging. And that's why you have this, the E&S market, which typically is non-admitted, although there's portions of E&S which are admitted. But that allows greater flexibility to price each risk separately. But that also means that there's a lot more paperwork involved and a lot more due diligence necessary, because every time you write a new policy, it's as if it's a completely new program. So two different clients will have potentially two very different legal documents and legal coverages, even though in essence they're trying to cover the same kind of risk.
So basically it's flexibility, speed to market, the ability to give the right, I would say, customized solution for the different policyholders and the risk that they are facing. And with that, of course, if they are working with the syndicates, and I think that they talked about that they have relationship with over 200 carriers and 15,000 retail brokers. So that mesh put them at the edge and sort of a distribution, a supply and distribution advantage.
Yeah. The other thing to just sort of keep in the back of your head is that in many states, if a broker is going to offer a non-admitted product, they actually have to try to get multiple quotes for a similar admitted product, because the state regulators would prefer that a client take an admitted product which has been regulatorily approved and vetted, which in theory is less risky for the client than a non-admitted product. So it does add a little bit more complexity to the quoting and bidding process, and drives up a little bit of additional cost as you think about having to actually solicit additional quotes.
Now, because the main business is the wholesale, and usually it's the 20% commission, so 10-10 divided with the retailer. Is there a difference? Does it make any difference for them if it's admitted, not admitted, or they have the binding authority?
Well, if it's on their binding authority, then they're taking on some of that risk, right? So there's a risk share component. So they could theoretically make more if they have appropriately captured the risk in the pricing model. Then when they have the binding authority, they'll ultimately make more money, and they'll close the deal much faster, which creates a much more seamless experience with their client, and ultimately ensures that the client isn't shopping around as much, right? Because if it takes Ryan a week to price and bind, but it'll take somebody else 2 or 3 weeks, the client, while they might have shopped it, will still close earlier rather than later for the most part.
I would say it's also the broker. As we know, brokers and agents, they have their own concerns and their own incentives. And at the end of the day, they will not or how it was defined to me, we are trying to sell what we can sell fastest. Not what's best to the customer, not what's best for us, but what we can close faster.
So,
And
so Gilad, I agree with you that that's probably inherently how the brokers work. But don't forget that many of the regulators have really been pushing hard on this fiduciary responsibility. And ultimately, that in and of itself, I think, becomes a slightly greater consideration. And I think, interestingly, perhaps even plays into the E&O and D&O space, because at the end of the day, you as a broker have an errors and omissions and perhaps even a directors and officers insurance policies. And those are the policies that will be liable should you be challenged for not meeting your fiduciary responsibility. So ultimately, if you're not doing a good job and the courts find against you, you just are driving up the other component of some of your operating expenses in terms of insurance premiums for that kind of coverage. So I think that, the last thing to talk about with Ryan is really more their marketing fluff, but at least share where they see their distinguishing features and why you should invest with them. And they articulate their future growth strategy really around a few areas. Having the best brokers out there and the best underwriters, making sure that they're innovating and leading change. And that's part of that discussion that I had mentioned around the connector and some other APIs and things like that. They do have an appetite to continue acquiring, and they believe that that's certainly critical for their growth strategy. And ultimately, they want to deepen the relationships with their current retail brokers. So, not different than any traditional insurance carrier on the personal lines place, which is, it's better to have many different kind of products with a customer than just a monoline product. And similar to what we were talking about, which allows them the speed to market and allows them better returns potentially, is to beef up that binding authority component of their business, which right now is the smallest. And on that note, it'll be interesting to see both where they price, what percent of the company Ryan and other insiders maintain, and what the initial reaction is to the marketplace. Many recent IPOs either popped the same day and then crashed, or actually ended up ending the day well below their strike price. So it'll be in time, we will see what happens here. But I think those are some of those key things remaining that we would want to see before we made a final determination here.
And after they publish the first public results, it will be great to talk about it again, to do our research and to compare them to other insurtechs and say, okay, we have this new old school company with that type of incumbent experience and mentality compared to all the cool kids. And that will be an interesting conversation as we see them progress. And who knows, maybe there will be surprises. Kainan, thank you very much for your time, and see you in a couple of weeks again. Have a good one.
I look forward to it. And thank everybody who's been listening to us. Please continue to give us comments. And if there are any companies you'd like us to sort of dive into, please let either of us know.